Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's a weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. One of the significant recent activities here had been the late August break higher above the July to August upper bear channel line. In the process of moving higher, prices formed an ascending wedge pattern. This pattern is highlighted in blue on my daily chart. This carried on higher until in late September, when the market's rise met a resistance that it could not overcome, despite trying for 4 weeks. This was the important, slowly rising long-moving average, currently 947, which had previously coincided with the November 2012 high at 930. This moving average was breached, but importantly did not have any 2 consecutive closes over it at any point in its testing. In early October, at the high water peak of the market, prices turned down with a very interesting weekly key reversal down, heading lower and through the lower trend line of the ascending wedge pattern. The market dropped below some significant supports, and it was only in late October at the slowly rising short-medium moving average, currently at 874, that we found the beginnings of some support. 3 weeks ago, I laid out what I thought might be the possibilities here for the future, and I quote, "There are now 2 avenues that I can see for this market, though there are no doubt more available that will eventually make themselves known. The first is a straightforward move down with potential targets for the ascending wedge pattern. Thus, a primary target X on the downside was already achieved in the 860 area, whilst the secondary harder to reach target X1 is way down below in the 712 area. This leads to the second avenue, and something that I have previously mentioned on a number of occasions. It is a possibility for the whole of the July to date action being not just a V-bottom, but a V-bottom with an extension. Personally, it looks a little slack as a pattern, but if the short-medium moving average manages to hold the market up, well, then this second scenario, the larger V-bottom with an extension, suddenly looks a lot more interesting." And that was the end of the quote. The early part of November looked very much like we had the beginnings of an up leg in a possible V-bottom pattern with an extension. In this case, as I say, a slack bullish halfway session, but the reversion back down in mid-week at that time countered that move. Last week, the medium moving average, currently 845, which had changed from support to resistance, really started pressuring the market lower below the November 2012 low at 843 and into the congestion from July and August this year between 775 and 840. Thus, the incentive, which, to be honest, as I said 2 weeks ago, was evenly matched between congestion both above and below, well, it is moving more in favor of the bearish incentive. So unless prices can rally, and real soon, to build up a better bullish halfway hesitation, then the dominance of the break below the ascending wedge pattern will become the prime driver, and target X1 in the 712 area will really start to look good. This week, nothing has happened that has changed that picture. But, and it is a speculative but by not doing anything as such, maybe the market is tempering the very recent bearish incentive. I would be very interested to see if prices can next week push back up over November 2012 low, as they have done this week. Chicago corn. Here are some of the key elements from my comments formed over the last few weeks. The first element is the reverse head and shoulders pattern over July and early August. It's turned out to be a good one, especially the slightly optimized neckline currently at 708, which I had highlighted in blue on my daily chart. This neckline had until recently been incredibly supportive when the market broke higher over it back in late August. The primary target for this reverse head and shoulders pattern has already been achieved, and I've decided to retire the secondary harder to reach target in the 714 area. Secondly is the impact of the slowly rising long moving average, currently at 643. This had earlier tried to cap the market, but as it separated from the 50% Fibonacci line of the September 2021 to April 2022 move at 661, its efficacy as resistance faded, with the market moving up through it. 2 weeks ago, it became both support and resistance in that week, and last week, purely resistance. Finally, the most important of all, there is the July to date ascending wedge pattern, currently at 746 to 777, 777. This is the one highlighted in red on my daily chart for ease of viewing. I'd personally found this to have been the most elegant of all the elements. In mid-October, the market exited this pattern, and for a couple of weeks it seemed the prices were looking to see if there was enough bearish pressure to make itself evident and push prices lower. Well, last week we found out there was. Thus, I initiated a primary target X for the break below in the 648 zone, with secondary harder to reach target X1 in the 550 zone. Now, I did raise a question 2 weeks ago as to whether there was also a possible very large V-bottom or bearish halfway hesitation pattern possible. I started addressing this last week in that I asked the question if there is to be a V-bottom with an extension, or if there is to be a straightforward bullish halfway hesitation. Then one or both of them needs to show itself right soon and in force. Otherwise, not only will the 648 level be in the frame, which it already is, but the 550 level will start to be looking very, very attractive. The things that may trigger such a move are already there. The 648 level to hold to start with, though that is more a last resort than anything else. Before then, we have support from the 50% Fibonacci line of September 2021 to April 2022 move at 661, which is sort of holding up the pattern at the moment. Plus, a little below that, the now starting to gently curl higher medium moving average, currently at 655, which has been tested once last week, and that is also support. Finally, there is the lower tie, currently at 650 of the September 21 to July 2022 bullish Andrews pitchfork. This one was below target X at 648 earlier this week, but has now risen above it. So there are some interesting levels nearby and below to watch out for. The market this week has seemingly realized exactly that, as last Tuesday's counter-to-counter combined key reversal up and bullish engulfing pattern, plus yesterday's outside day that was also a hanging man pattern, has shown. However, prices are not that far higher in spite of all this work to try and make it, which is a concern for the bulls out there. Now, I'll be interested to see what will happen in this coming week with them. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.